Hello, everyone. Welcome to CPA Canada's 2023 Federal Budget Highlights webinar. My name is Vivian Young, and I'm a Senior Principal in the Taxation Group at CPA Canada. I'll be moderating today's session. Joining me, we have Bruce Ball, our VP of Tax. Hello, Bruce.
Hi, Vivian.
So I'm sure by now many of you have read or heard about some of the tax measures that came out of yesterday's federal budget. And I'm sure many of you are trying to determine how those changes might impact you or your clients or business. Our goal today in this session is to provide you with an overview of some of the key measures that you need to be aware of. I wanted to point out that we also have a written summary called the Tax Highlights that's available on our website. So I do encourage you to have a look at that once you've completed viewing this webinar. So without further ado, I'm going to turn things over to Bruce, who is going to be providing us with the overview of the budget. Bruce?
Okay, thanks, Vivian. So maybe just before we start, what we've done with both the highlights and the session today, we're highlighting some of what we saw as more of the key changes. So we haven't put everything in here. There are a few items that you'll need to look up in the budget documents. The other thing is, especially when we talk about the environmental measures, but for all of the changes generally, there's a lot of detail in some of this. And again, we're going to provide you with a bit of an overview. Again, you'll want to look at the budget documents to get more detail. For some of these things, we will definitely be doing more later. The general anti-avoidance rule and the response to Bill C-208 will be providing more information, I think, as we consult with members and provide feedback to government. So there will be more coming on some of these things as well. So getting into the key measures, we're going to start off with corporate and business changes first. Some of the things hit in personal, and we'll get to that, and we will discuss the general anti-avoidance rule more toward the end. So we'll start off, though, with the business corporate changes. So there were a few things that we knew were going to be in the budget this time, or we assumed would be, because the federal government had said there'd be more details in the budget. And our first item, the tax on share buybacks, was one of those things that we were told that there'd be more details, and there were. It looks as though there aren't any big surprises there. It's a 2% tax at the corporate level. It's on the net value of public company share repurchases, and they've put in other entities that are publicly traded as well, such as REITs and some SIFs as well. It is the net value, so I guess the idea is if you were to issue shares from Treasury during a year and also doing buybacks, you'd be able to net the two. I'm not sure how common that would be, but if that happens. There's also a de minimis test of $1 million that'll apply as well. So again, I'm not sure there's any big surprises there, but it will be effective for transactions after 2023. So it'll start 1st of January 2024. And just finally, it'll apply generally to Canadian resident corporations. And as I say, publicly traded on a designated stock exchange. The second item is actually a series of many items, and I would say it took up a fairly large part of the budget narrative in terms of the tax changes yesterday. So I think the best bet, honestly, is if you have either for your own employer or for your clients, if you are into any of these, you really will need to take a pretty detailed look at the rules, because they really have changed a number of things. They've introduced some new investment tax credits. They've modified some rules too. So just as examples, there was that reduced corporate rate on eligible zero emission technology for MMP. So nuclear manufacturing's been added, for example. Lithium's been added as a resource for exploration and development activities, and also for ITCs, for the critical mineral ITC. So just some other examples there. And some new credits. There's a clean electricity credit, a new credit for clean hydrogen, and they've also, again, expanded some of the rules. So there was an existing ITC for clean technology related to geothermal. So that's been expanded out to include some new CCA classes. So as I say, there's lots of detail there. One thing that's interesting, though, it's a little bit different, I think, than other ITCs in the past. They have built in labor requirements. So as part of the work and qualifying for some of these credits, you'll have to meet certain conditions in terms of what you're doing with labor generally. So again, that's a bit of a change, and you'll have to also check on how that works as well. So like I say, a fair bit there. Honestly, we probably could do a webinar just on that sort of thing. But I think it, like I say, for those who are in the area, they'll have to take a really detailed look to see if they qualify for some of these things. The other thing that was in the budget, it's interesting, there wasn't a whole lot of description. The third bullet on the screen here, the dividend deduction for dividends received by financial institutions. As I say, very little discussion. This will be for shares that are marked to market properties. So the idea being is dividends are received, they'll be taxable. There won't be a deduction for them. The thing I found interesting, and there was some discussion in the media just within the financial sector, it is $3 billion of tax over 4 years. So it's a fairly significant item, even though it didn't take up a lot of space in the description of the tax items yesterday. So, you know, there were media stories this morning about the Canadian Bankers Association discussing the issue with some concern. So we'll have to see if there are other developments on that. But as I say, that's another thing to watch for financial institutions. Another thing that they dealt with yesterday, and it's been corrected retroactively, is the income tax and GST treatment of credit unions. So there's a revenue test that would apply, and I think the concern was that the revenue test doesn't really sort of reflect current reality for credit unions. So the budget yesterday proposes to eliminate the revenue test from the income tax definition of a credit union. And this will be effective back to 2017 and later taxation years. The last item on the list, there wasn't a lot of detail, unfortunately, but this is something we've been watching pretty closely at CPA Canada, along with members of our SR&ED group or committee. There's been the talk of a review of the SR&ED program and also looking at patent boxes for a couple of budgets now. And we recently have been talking to the government just to make sure they understand that ongoing uncertainty in terms of a program, especially if it's one based on, which can be based on capital expenditures and, you know, setting aside money for projects. There has been some concern for those who qualify under current rules. They're concerned, you know, how is it going to change if there is a review? So we did have a discussion with government and encouraged them to, well, two things. If they could provide more information, I guess, as they do the review in terms of what they're looking at, that would be helpful. But also if they could complete their work and provide something to stakeholders for feedback at their, you know, as soon as they can. Because as I say, there is some uncertainty and it's very difficult to tell people what's going to happen with the program. So we have been encouraging the government to finish their process and be as transparent as possible. So we'll turn to personal changes, and there was probably more here. I think the first three items especially, actually, a fair bit of update here. The first item is the intergenerational business transfers. We called it also the Bill C-208 follow-up. So just as a real quick bit of background on it, this is the issue around Section 84.1. So the concern, which had existed for quite a while, is that if I own a business and I were to sell it, I could have better tax treatment if I sold to third parties. They'd be able to use a corporation, which is useful because you can use corporate after-tax corporate earnings without personal tax to buy the corporation from me. I can get my capital gains exemption, capital gains treatment generally, and they don't have issues on their side. They probably quite often do a holding company, maybe followed by some sort of wind up or combination, so they get interest deductibility. So it worked very well. The big problem was that you couldn't do it even if you were doing exactly the same sale with related party. You'd have a problem with 84.1. So the government had been looking at changing that for quite a while. They've done at least one consultation, I think probably more over time. But time was going by, so private members bill brought in Bill C-208, which made the process much more straightforward from the perspective there weren't too many conditions. The federal government had concerns. I suppose there wasn't enough integrity in the rules, and they had promised some time ago that they would bring out new proposals to add in some more integrity to the rules, but also trying to make sure, excuse me, that they do take care of the problem for bona fide intergenerational transfers. So we finally saw the response yesterday. So the details were released as part of the budget yesterday. So it will apply, maybe the first thing to keep in mind, it will apply for transfers after 2023. So the rules will continue to apply under Bill C-208 for the balance of this year. The key, maybe some of the key considerations, and maybe as a bit of background as well, CPA Canada didn't make a submission on this because honestly, there were different views from different people in terms of what was sort of a reasonable balance between the right amount of integrity and flexibility to take care of genuine sales. So we did, though, as part of our work, get some members together to discuss how they thought they'd like to see the rules work with the Department of Finance. So we'll have to see, before I get into the details, we are going to consult and just check with members to see what the issues are. At first blush, it does look like they've tried to sort of take into account some of the things they were hearing. So we'll see if they struck the right balance and not. We'll, as I say, get some feedback. So maybe just getting into the rules. So one thing to consider, it has to be a sale by a natural person. So we're talking about sales by individuals and not a trust per se. So, and you have to be selling to a corporation controlled by a child. And they did expand this a bit too. So a child could include nieces and nephews, stepchildren and grandchildren, grandnieces, grandnephews. So the group of controlling people of the corporation that's buying the shares is relatively broad. It goes further than just being children. What they've done is they've just sort of created two paths, I suppose. That might be the best way to describe it. Sort of a path if you're doing an immediate transfer of the business, and a path if you were doing more of an estate planning, estate freeze kind of approach. So there's a 3-year rule, and then as a rule that they refer to in the notes as a gradual rule that's more unfolds over 5 to 10 years. So maybe just looking at the 3-year rule, essentially things have to wrap up within 36 months, essentially. So you have to transfer legal and factual control pretty well immediately. Voting control would have to go as part of that, but factual control as well. Means balance of the transaction within 36 months. You also have to transfer management within 36 months as well. It does look as though you could keep some sort of residual interest, but it would have to be preferred shares, non-voting preferred shares or debt, perhaps. So, but you'll need to take a real detailed review of the rules just to see how it all works out from that perspective. I think the other key point is you'll have to plan it as well. So you probably would want to start taking some steps maybe before you actually do the transaction. For example, integrating the next generation into management. You don't have to do that during the 3 years. You just have to have it done. So that would be one thing. For example, you could move the day-to-day functioning in advance and then deal with the sale kind of thing. The gradual rule will give you a little more flexibility. You'll be able to do it, as I say, over 5 to 10 years, and it could follow sort of an estate freeze and redeem out share kind of approach. And they did pick up on, I'm pretty sure this was one thing that we'd mentioned just on longer term situations. Control is a bit of a concern if you're going to do it more gradually, because factual control could exist. For example, if you still have a significant financial interest in the company in terms of de facto control. So they will allow de facto control to move at a different time than legal control if you do the gradual process. But again, some of the things are similar to the 3-year rule. You still have to otherwise move legal control management within 36 months. Each rule will also have a rule in terms of the child that referred to before of the corporation making the purchase, how long they need involved. So that's something else to take a look at. One issue that is interesting that's in there as well is there's a reserve now proposed, a 10-year reserve for the shares. Generally speaking, if it's a non-arm's length situation, a capital gains reserve can be a problem if there's a corporate purchaser. But in this case, they are proposing to change the rules and allow for a 10-year reserve, under the usual rules. Another significant change is what they're going to do with the alternative minimum tax. So this is also going to be effective for 2024. And it is broad. They've essentially changed everything, really. I mean, the concept is similar. It's going to be an alternative process to calculating tax for individuals. And if your tax is higher under the alternative minimum tax, then that's what you pay. One thing they aren't changing is the carryover as well, so that'll still be 7 years. So if your AMT is higher than your basic federal tax, you can carry forward the excess and apply it in a future year when your basic tax is higher than your minimum tax. But other than that, there's a lot here that's changed. Starting off with the rate, they've raised it to 20.5% from 15%. So that's the starting point. The rate's higher. The good news is the exemption's higher, though. They've geared it to the fourth tax bracket, so they're predicting it'll be 173,000. So that's up from 40,000. So I'll talk a little bit about that at the end, but that'll be a beneficial change for sure. So in terms of the tax base, there's been a lot of change there. Capital gains will be included 100%. They talk about capital losses being applied at 50%. So that'll make a significant difference. They're also going to bring in some other exempt gains to sort of match up with the same treatment for the capital gains exemption. So 30% of gains eligible for publicly traded shares, for example, that'll be put into the tax base. They're also going to broaden the some deductions, I guess, and credits that can be claimed, and they're basically taking a half. So some of the expenses that'll be restricted, or essentially you'll have to add back some of the expenses, employment expenses other than expenses for commissions. That will be fairly common. Childcare is another relatively common, moving expenses, non-capital loss claims. So there's quite a list of items in there. So they'll have to be added back essentially to the AMT base before you calculate the credit, or calculate the tax, I should say. Same idea on some of the credits. Again, you'll only be able to claim 50% of the amounts that you claimed for basic for the calculation of basic federal tax. So there's a lot of change there for sure. I guess I had, at first blush, I think the first thing is you're going to have to think about the usual rules of thumb you might use when you think about people who might be subject to AMT, because I think they'll change. But it does look positive from the perspective that the number of people subject to AMT, the Department of Finance believes it'll actually go down. And I think one scenario might be just where you're receiving eligible dividends. If you're income is composed mainly of eligible dividends. They don't have to be that high before you fall into the current AFP. So with 173,000 exemption, that might make a fair bit of difference there too. So I say we'll have to see what happens. There was a mention of more details coming later in the year as well. How that should say. The next item before we do a few quick updates, employee ownership trust. And this is an interesting one as well. There's been discussion, at least the last couple of years, maybe this issue has been discussed with finance going back even further, but they have talked about it in the budget. They did talk about it in the budget last year, and they had more details in the budget this year. So the idea was that they wanted to create a vehicle to allow employee ownership of corporation or business corporations. So, if again, if we're looking at succession, is selling to the employees as a group a possible approach. I mean, under the way the rules are now, and especially with generally having to give or sell shares to those taking over the company, it does create some issues if you want to sell to a wider group. There's just issues especially with private companies when you're trying to deal with share ownership. So the idea is to create a vehicle which would be an employee ownership trust as a means to allow employees to own the corporation. So there's more in the budget again, but some highlights. The idea is that you could set up a group of employees in a trust, and their rights under the trust would be based on their employment status. So things like the number of years of service they have, remuneration, hours they work, that sort of thing. The idea is that you use those tests to create a participation percentage for distributions. A few other conditions too. The trust is required to control the business corporation. And for the corporation that's going to be in the trust, all or substantially all or 90% or more typically of the assets would have to be active business assets. And just as another sort of a governance issue, the trustees are elected by the beneficiaries. So, and the beneficiaries need to be qualified employees, which is again defined, I should say, in the budget papers. So just on the tax side, just some general rules, because they had to create some rules so this would work. They did confirm that it will be a personal trust, so they're taxed at the top rate. So you can pay as dividends, they retain their character, that sort of thing. You can also transfer shares to the trust, and I'm going to repeat what it said in the budget papers, at an amount no more than fair market value. So it does seem to allow for, if there's a desire, I suppose, to transfer at a lesser amount. It looks as though that would be possible. So that's useful. They've also, again, similar to the Bill C-208 changes, they've also allowed for a capital gains reserve. So again, if I'm the one transferring my business corporation to the trust, I'd be able to claim a reserve if I'm going to be paid out over time. Another rule they had to take care of was the Section 15 rules for shareholder loans, because the idea is that the corporation would be able to loan money to the trust to help fund the buyout. So basically, the rule will say that if for shares subject to these new employee ownership trust rules, the repayment period won't be 1 year; it'll be 15 years to avoid a Section 15 benefit. And another issue that they had to deal with is the 21-year rule. So again, a lot of detail, but they're planning to have this effective for January 1st, 2024. Just speaking to a couple of people in the lockup, I think the big question, probably two questions, are there other technical issues that need to be dealt with? And I think the other part might be just the business community getting to know these rules and deciding whether they want to use them, because it's really a tool to help facilitate employee ownership. It's not as though it's a beneficial rule otherwise, other than just creating the mechanism to let this work. So we'll see what the take up is, but it's very interesting. These have been used in the U.S. and the UK, so interesting to see what happens in Canada. A few other things, there was an increase to the GST credit for the grocery rebate, as it was referred to in the budget, so they've upped that amount. There were some changes to registered plans, so really just almost more technical changes, I'd probably call them. So just as an example, the RESP rules, they've increased the amount that can be withdrawn as education assistance payments to $8,000 if you're a full-time and eligible student, and $4,000 for part-time. They've also created a rule that divorced or separated parents can still open a RESP. So both of those changes will be effective budget day if they're passed. There was another rule as well that for registered disability savings plans, one issue would be for individuals who are mentally challenged, are they able to open a plan? So there was a rule that allowed others to sort of step in and open a plan for them. So they're going to extend that. It was a temporary provision, so they're going to extend it 3 years. So this will continue to 2026. And they've also broadened it to say that other family members can step in. It could be a sibling now rather than just a parent, spouse, or common law partner. So that change in terms of the sibling, that'll be effective on royal assent. And a couple of other things, there were some, I won't get into it in detail, there were issues discussed for registered compensation arrangements, or RCAs, unfunded plans where there are fees for letters of credit and that sort of thing. They'd be subject to the 50% tax normally, so there's a rule that'll relieve that. And the deduction for tradespersons has been increased from $500 to $1,000, and that's effective for 2023. So on the international front, there is some update information, but I think really more confirmation that the government's plan, generally speaking, hasn't changed a great deal. So what we're talking here mainly is the Pillar 1, Pillar 2 initiatives that the OECD is conducting, and they are moving along. Pillar 1 dealt with the reallocation of taxing rights. And it's very complicated. I believe, we see updates from them from time to time that they are moving forward. The government is hoping, I don't know if it's a plan, I'm sure, probably a bit of a hope too, that they're hoping that an agreement can be signed by mid-year and come into force sometime in 2024. So linked into that is the digital service tax. The legislation is, I guess, just waiting for further changes to see what happens next. So just as a reminder, this was a bit of a different approach, I suppose, in terms of tax legislation. I'm not sure I'd seen something quite like this, but the idea is that the tax, if it does become effective, it became effective as of January 1st, 2022, and it's effective if they don't get Pillar 1 done, essentially. So it is a bit retroactive. It does seem that issue is pretty much the same as it was. There were concerns, for example, around financial reporting, how do you report, that sort of thing. So I don't think there's any update there really. As I say, the hope is finish the plan at the OECD level this sometime middle of this year, and then hopefully it comes into, hopefully from the government's perspective, they hope it comes into force in 2024, and that'll eliminate the need for the DST. The global minimum tax, Pillar 2, again, there was some updates there. I think we're going to see some legislation in the coming months, I think was the phrase used in the budget. So we'll be watching for that. And it is scheduled to start coming into effect for taxation fiscal years that start after December 31st, 2023. So again, we'll have to watch for details on that. So another interesting topic is the what they're doing with the general anti-avoidance rule. And again, this is an area where the Joint Committee with the Canadian Bar Association, we didn't do a submission. Again, it was fairly general in terms of what the government was consulting on in their consultation paper last year. So again, we thought the best approach was to have members of the committee have a discussion with the Department of Finance just on general things to consider, I guess, on all the different approaches that were mentioned in the paper. So in yesterday's budget, the Department of Finance took the feedback and they came out with, I guess, preliminary proposals might be the best way to describe them, because it will be subject to another consultation that ends at the end of May. And then they'll bring out final rules and the actual effective date once they go through a second round of consultation. But it's, I think basically they took the feedback that they heard and they came up with more focused proposals on what they'll do. And there were probably 5 different areas, really, when you break it down. One of the concerns they had, and this is a little bit different in tax legislation when you look at the Notice of Ways and Means, was to discuss as legislative provisions what the GAR was designed to do. So they've incorporated that as wording, proposed wording. So the idea of this preamble was to address interpretive issues and help, I guess, guide more of the courts, I suppose, in terms of how the government intended that the GAR applies. So that was the first component. The second component, and this is, it could be fairly significant. We'll have to see how it, shakes out over time if it is part of the final GAR proposals that are released after the consultation. They're going to change the wording of avoidance transaction from primary purpose to one of the main purposes. And I think this had come up in a few other rules that the Joint Committee had discussed with the government. And it's harder, I think, what is the main purpose? Primary purpose was probably easier to establish. One of the main purposes is a little more unclear. So we found that was feedback that we were giving them on some other things, recent changes. So that might be a bit of a concern, just the certainty around what is the main purpose. So another thing that they're going to do is, and this was required, I think it was actually in a public document that the government actually wanted economic substance to be considered as part of the general anti-avoidance rule. And there were different ways discussed in the consultation paper in terms of how you might do that. What they chose is, again, sort of this preliminary proposal subject to more consultation, is to have economic substance considered as part of the abuse or misuse analysis. And they put in an example of the tax-free savings account, because I think one of the things we were certainly discussing in our call with them, and I'm sure others were, is there are things that are acceptable that don't necessarily have a lot of economic substance. And they used the tax-free savings account as an example, because essentially, if you ignore tax, you basically just moved it from one investment account to another. So basically, they said that as long as it's clearly established that what you're doing is acceptable, then it doesn't have to necessarily have economic substance. It's just more where it doesn't, you'll have to put it through more analysis. So again, that is a change that'll have to be sort of worked into the GAR analysis. The other thing that I think was something that could be predicted. I think one concern over time has been the issue that GAR is a self-assessment process, and it was really on the government to find things that they thought GAR applied to and then deal with them. I think a lot of people were expecting that some sort of taxpayer onus would be included if they did update the general anti-avoidance rule. There'd be different ways to do it, but it looks like the government has arrived at the idea that they're going to assess penalties on the amount of tax benefit where GAR applies. And when we discussed this with government, we really did say, if you choose to do something like that, it would be good if you have a way to, make sure you can mitigate that though too. And they've worked that in there by saying that if it's reported, now it might be under the mandatory reporting proposals, and there was no update on that yesterday, or it could be as part of another report. If you reported the transaction or the situation to the government, then the penalty wouldn't apply. So that's how they are approaching, I guess, that issue. And finally, they're going to extend the reassessment period uh, and by 3 years to give them more time in terms of the reporting. Now, again, you'd be able to shorten the reassessment period if the situation is reported. And finally, there were a few changes to indirect taxes. We focused on one because it was an issue that we had been discussing in our commodity tax committee, and it's been in the media as well. And that was payment card network operators, the fees they charge. In the CIBC case, it was ruled that these fees were exempt. The Federal Court of Appeal had actually overturned the tax court. And I think the concern some had was they were sure that the government would deal with this, but how will they? Will they deal with it retroactively, or what would they do? So they did make propose a change yesterday in the budget. So they're going to say that these services are subject to GST, but it'll be in respect of a supply that becomes due or paid without becomes due or is paid without becoming due before March 28th. Or after, I should say, March 28th, 2023. So it's basically going to apply on a prospective basis. So I think, as I say, we probably knew a change was coming. So I guess that treatment at least means that there won't be retroactive application, hopefully. So Vivian, I think that was my overview, but
Great. Thanks so much, Bruce. Yeah, thank you. I think that your summary and your insights really, I think, will be helpful to those watching this webinar and helping them better understand how some of the key changes might impact them and their clients or business. So, Bruce, with all these changes, I'd love to hear your thoughts actually on what the key takeaways from this budget are.
Yeah, thanks, Vivi. As I say, the employee trust changes were interesting and a fairly major departure. I think or development, I should say. I think the one issue there is just, what will the uptake be? So I was really focused on three things, I think, and all three of them we're going to have to watch for developments and also consider the impact. I think one, the AMT for sure for individuals. Like I say, a lot of things to think about. Some people are going to be in it, some people maybe not. How's that going to work? How's it going to impact planning? That kind of thing. So it'll be interesting to watch. I think everyone will have to keep an eye on what's happening. The other thing, and something we will ask government about as the year goes by, if we could somehow see them provide maybe some of the forms or that sort of thing to the software, tax compliance software providers. Because I think people will want to do calculations. So something we'll have to definitely keep an eye on. General anti-avoidance rule, obviously, subject to another consultation. So we'll be talking to our committee members just in terms of what next steps are there as well. And Bill C-208, I think there'll have to be a lot of thinking in terms of company or businesses and their advisors. Business succession, I've always said, is a process. It's not an event. So again, a lot of people might already be in the process, but will be completing the transaction after this year. So they'll have to take the new rules into account.
That's great. So there is definitely lots to look out for in the coming weeks and months. Bruce, I have another question for you, not really related to the budget, but it is a current event. Many of you watching this webinar may know that CRA made a pretty big announcement kind of on the eve of the budget on the 27th. They made an announcement regarding the underused housing tax returns and payments. Bruce, can you give us a little more background behind that and insight?
Yeah, this is something that we've been following for sure. I'll be honest, the impact on Canadians kind of snuck up on a lot of people, I think. The one issue that's arisen that's been a fairly big concern is the whole idea about how Canadian owners are treated. So the underused housing tax, it's designed to be a tax on underused residential property held by non-residents. That was the premise of it. But when the details came out and more guidance from the CRA, it became very clear that a lot of Canadian ownership situations are going to be subject to reporting. They won't have to pay the tax, but the penalties can be pretty extreme, either 5 or 10,000, depending on the nature of the owner, if you don't file a return. And that's even if you're not paying the tax. So it is pretty big and was causing a fair bit of concern. The what we had asked the government to consider is an idea of maybe some sort of administrative exemption for 2022 for these Canadian ownership situations. So where you own using a Canadian trust, partnership, or corporation, so there's no non-residents involved. It's all Canadian. We suggested there's going to be a lot of filing here. Could that somehow maybe be waived for this year, and then we look for better ways, if necessary, to get the information to government? Because it does seem like including it as part of an income tax return would have made a lot more sense than trying to do these individual filings. So we haven't heard anything on that response, but as Vivian said, there was a big announcement yesterday. I think it's probably good. It's a good news, bad news announcement, I suppose, because it does seem to confirm that you will have to do these filings for Canadian entities. Other than the individuals who own property directly, they won't have to file, and that's still true. But the good news is that we'll have more time. The CRA, we called it an administrative extension. The idea is similar to some of the extensions or relief they gave during the pandemic. They won't charge interest or penalties as long as you file the UHT return and pay any taxes owing on or before October 31st. So that's good news, I think, from that perspective. I think part of the concern as well is the CRA's received a lot of questions. They released some of them on Monday as part of the announcement, and there's quite a few more that we're expecting to come out shortly or soon. We're not totally sure exactly what that means. We're hoping in the next week or two, but there are more questions to come. So I think that might be part of the reason why the extension or this administrative relief was provided to allow people to file later, because there are a number of questions. I will point out, too, that there's some situations involving Quebec where the government is looking at it. We still haven't heard. The issue seems to be it's Canadian ownership, but it just doesn't match up with the specified partnership or specified trust exemption. So the CRA is looking at that, and we're hoping that they'll be announcing something on that shortly as well.
Great. Thanks again, Bruce. So that takes us to the conclusion of our webinar today. Thanks again for watching. I did want to remind everyone, as we mentioned at the beginning of the webinar, we do have a tax highlights document, which is a written version of a lot of what we discussed today. So you can find that on our website, and the link is right there on this slide. As Bruce kind of overviewed for us, there are a lot of changes, and there's a lot of details still yet to come. So if you haven't already, I do encourage you to check out our tax news page. And again, the link is there. Bookmark it and come back often. We do put most of our, well, actually, we do put all relevant and significant updates that we feel is important for you to know about on this page. So check back often, and we'll keep you informed in that way. So thank you again for logging in today, and have a great day. Bye-bye.
Thanks.